In 1923, the German currency lost all value as it hit 29,500% monthly inflation. Today, a similar pattern is emerging, with central banks around the world struggling to manage monetary policies that can lead to economic disaster if mismanaged. This is not just about Germany or Zimbabwe. It's about understanding why and how governments often resort to printing too much money and what lessons history teaches us about such actions. What's happening today makes this topic crucially relevant. In recent years, central banks globally have engaged in unprecedented monetary easing measures like quantitative easing, QE, in an effort to stabilize economies after crises. However, the risks of over-reliance on such measures are significant, as history has shown us. The stakes are high. If a government prints too much money without economic growth to support it, inflation can spiral out of control, erasing the value of savings and causing widespread hardship. To understand this pattern, let's look at two key historical parallels: the Weimar Republic in Germany from 1921–1923 and Zimbabwe from 1999–2009. In Weimar Germany, the government printed money to pay reparations for World War I, leading to hyperinflation where workers were paid twice daily as prices doubled hourly. This not only wiped out middle-class savings, but also led to political instability that paved the way for Hitler's rise. Similarly, in Zimbabwe, land reform destroyed agricultural output, and the government responded by printing money to cover deficits. Peak inflation reached 89.7 sextillion% in November 2008, with a $100 trillion note issued. Only after abandoning the Zimbabwean dollar did the economy begin to stabilize. Why does this pattern keep repeating? The underlying mechanism is clear. Governments and central banks often resort to printing money as a quick fix for economic problems without addressing structural issues. While it can provide short-term relief, such measures risk long-term damage through hyperinflation or other destabilizing effects. There's also the trade-off between immediate fiscal stimulus and sustainable economic growth. Governments must balance these needs carefully. The lesson for today is that understanding history's patterns can help us avoid repeating its mistakes. Viewers should watch out for signs of over-reliance on monetary easing without corresponding economic reforms. This ensures they are better prepared to navigate potential financial crises in the future. The takeaway here is clear. While printing money might seem like an easy solution, it carries significant risks that must be carefully managed.